I have the pleasure of welcoming Alasdair Macleod. You've been a long-time analyst of, I guess I can say, monetary affairs, and you run the Macleod Finance Substack. And I would recommend to everybody that become a paid member. It's worth every penny. Alasdair, welcome.
Rigard, thank you for having me.
Good. We haven't spoken for a few years, so I'm really looking forward to this. And I guess with everything going on now, with the tariffs and the volatility in the markets, I thought it best to start with the tariff side of things. And yesterday was kind of wild, to put it that way. Markets being down 5%. Then came the news, or like this, about Trump pausing the tariffs for 90 days, which turned out to be fake news. And the markets then fell again, not as much, but there are so many things happening. And can you unpack these things, please?
All right. Okay. I mean, the tariffs are very, very real. It's not just a question of negotiating, to try and open up markets for the US, to reduce unfair competition, whatever. Basically, what Trump is doing is he's trying to go back to the days when the federal government's revenue came from tariffs. And this was before income tax was introduced, before the First World War. So that is actually what it's about. That's what he's trying to do. And so the idea that he's going to sort of, give up on tariffs, we can forget. If he does that, it'll be a real crisis for America. I mean, it's a crisis whichever way now, because the problem with tariffs is that it's going to put up prices in America, and it's going to do it from really 2 points of view. First of all, obviously, you've got, tariffs are a tax on consumption. Basically, that's what it amounts to. It's a selective tax on consumption. So prices will rise from that point of view. And the second thing is that with if you like, the reduction of availability of overseas goods going into the economy, the inflationary consequences of a budget deficit will become even more apparent. And I think that it's that hidden bit that people don't fully appreciate or factor in. And I'm seeing lots and lots of optimistic commentary, hoping that, the consequences of tariffs will not be to drive up prices that much, because the manufacturers abroad will reduce their margins, and the importers will reduce their margins, the wholesalers will reduce their margins. So the consumer will not end up paying much more. And consequently, the Fed can cut interest rates over 2025. It's rubbish. It is absolute rubbish. I think, the markets obviously understand this. And the markets at the end of the day get these things pretty much right. And this is why the market has been falling. But the tariff story is a trigger for a set of circumstances which, if you like, is a doppelganger, as they say in Germany, for what happened between 1929 and 1932. In the run-up to 1929, we had the Roaring Twenties, which was a credit boom. We have today a far larger credit boom. And for those that don't understand a credit boom, just look at the debt side, because credit equals debt, the two sides of the balance sheet. The amount of debt in the world today is absolutely phenomenal. And most of it is now unproductive. It's either governments who never do anything productive with debt, and also zombie corporations and all the rest of it, who really shouldn't be there. They should have gone. They should redeploy their capital to more productive means. But they're not doing it. So it's not just America, all around, certainly the Western world, this debt is unproductive. The other side of it is the credit bubble. And at the same time, we've got Smoot-Hawley Tariffs Act Mark II. The difference is the credit bubble is far larger than it was in 1929. And also the tariffs have a far greater effect today than the Smoot-Hawley tariffs in those days because of two things. First of all, in 1929, the US economy was pretty much self-sufficient. Yes, there were some imports, but it was less than 2% or 3% of the total economy. Today, this is very, very different. If you're looking at trade, I mean, it's more international now. You've got, you've got supply chains going around the world and all the rest of it. And it all depends hugely on logistics and so on. So actually dismantling that is likely to be far more disruptive than even the Smoot-Hawley Tariff Act. Now, the combination of that relatively minor set of, credit bubble bursting plus Smoot-Hawley Tariff Act was to drive the Dow Jones down by almost 90% between September 1929, and the middle of 1932, and 9,000 banks went bust. We have this situation today is likely to be far more violent. This is what the market is now waking up to. And if I am right, there is considerably more downside in this market. I suspect that what we're likely to see is further downside in the coming weeks. It will probably temporarily stabilize, just as it did in November 1929. There will be some sort of rally. How long it will last, we don't know. I think the rally will be encouraged by intervention by central banks, particularly, perhaps, the US Treasury. They have the means to intervene in the market to try and support it because they see wealth, the preservation of wealth as being fundamental to the US economy. So they're bound to intervene. But then what then happened in 1930 through to 1932 was you had this awful long slide in values, in stock values, just going down, 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 down. And I think that will probably start at some stage later on this year. So it's people waking up, I think, to these realities. And so far, nobody's really considering the full implications of it. But this is extremely dangerous. And of course, what we're looking at in the case of stocks and all the rest of it is we're looking actually at credit. And you can't destroy credit other than by going bust. In other words, defaulting on obligations. And I mean, particularly in the case where we don't have a gold standard, because the other way in which you can extinguish credit is by buying gold. But the whole of this situation is that what banks are doing, because they're over leveraged now on their equity, they're moving out of risk. They're moving out of lending to small and medium-sized enterprises. They are now basically focusing on lending short-term to governments, treasury bills, that sort of thing. They don't want the duration risk, and they don't want the lending risk. So that's what they're doing. And furthermore, the regulators are telling them that is the risk-free way of lending. And so that's the way in which they sort out their balance sheets. This really goes to guarantee, if you like, a slump in business activity. So you can see that it feeds through from that point of view. Furthermore, if you look at the lending statistics in America, there's almost $1 billion being lent for stock margins. So, that is also going to be unwound. You've got the commercial real estate problems. And then you have got the central banks who are deeply into negative equity. And their backers, who tend to be governments, are in a debt trap. It's very difficult to see how credit can actually survive this hiatus.
What maybe a bit difficult question, but what's the way out of this then? Does gold have to some way enter the equation, or the money equation, if you will, at some point? Not by choice, but by necessity.
Well, eventually it will, yes. Eventually it will, and it must. But how long we take to get there, because intellectually we don't have the ability to understand the difference between money and credit and why gold is still money, despite the propaganda campaign run by the US Treasury to make the dollar gold's replacement. And that's a propaganda activity that started in the early 1970s. So I think we have an intellectual problem. We also have a political problem because we're all hooked on the state will look after us. The state cannot afford to look after us. So there's that aspect of it. There is one good thing in all this, and that is that you've got the Asian hegemons in the form of China and Russia as ringmasters for the Shanghai Cooperation Organization, which covers much of Asia, and also BRICS. And then you've got a whole number of countries which are, if you like, not in that camp, but thinking of jumping into that camp, but frightened to do so because of what America does. America, I mean, they owe money in dollars, for example, and America can get the IMF to screw them into the ground. So that's one aspect. The other aspect is that America in the past has engineered, if you like, sort of government replacement, coup d'etats, and so on and so forth. So any politician who decides to go against America is taking a huge, great risk. Now, I think that given Trump's policy of America drawing in on itself and reducing its involvement abroad, that I think is going to give a lot of confidence to many countries on the sideline who will now feel that they can actually align themselves more with the new world. And this new world is actually the majority of the world's population. So there will be demand, continuing demand for commodities because this new world is far larger than us and it is rapidly industrializing. And to the point, China has been talking to South Korea and Japan about trade alliances for some time, but it's never really got anywhere. It's like all these trade talks, they go on and on and on, and the progress is sort of incremental if you're lucky. But now this move has basically accelerated this process. And I think quite quickly you will find that South Korea and Japan will ally themselves with China so that you will get, if you like, in terms of technology behind consumer products, you will get the best in the world, better than what America has, all coming together. And then Russia has the missile technology. I mean, nobody else is, except possibly the Chinese, has cracked the sort of hypersonic Mach 10 missile speeds, which are basically just can't be stopped by the sort of, if you like, the defense umbrellas that we have in the West. So this is moving away from us. So on the one hand, we're seeing our Western world dying. And on the other hand, we're seeing the Asian one rising. This is, I think, a very important time. And Trump's move on tariffs has actually clarified this position hugely and accelerated the change immeasurably from the old financial world into the new productive world.
Okay, good. There's one thing that I, at least from my side, I think was quite a lot in the news a while ago, and that was the Mar-a-Lago Accord. And you have, I think his name was Stephen Milan, wrote the paper, and I think he's now advising Trump as well. Is that what do you have any thoughts about that? Is that the way to go, or maybe not? But they want to restructure the debt side of or the U.S. Treasury, the maturity side of it. Is that the way to go?
Well, I think it's all wishful thinking, I think is the answer.
Okay.
The fact of the matter is, and this is, we've got to go back to what's happening to the US economy. The US economy is sliding into recession, and it will become a slump, in my view, because of the dynamics of the collapse, if you like, of the largest credit bubble in history, coupled with this tariff, Trump's tariff policies. What that means is that in terms of government debt, you're going to see a significant increase in the budget deficit. That's the first thing. And then you've got to think about the position of the existing debt. And the position of the existing debt is that you've got this debt mountain, which is over $36.5 trillion now. I'm talking about government debt. And the revenue, if you like, that in theory will pay this debt down or continue it, you can continue to let it sort of, if you like, remain. The revenue is declining because the economy is getting into trouble. Now, that is a classic debt trap. In other words, the problem that the US government finds itself in is that it can no longer fund its current debt. So when it wants to increase its debt, because it's got this increasing budget deficit, which will go quite rapidly from 2 trillion to 3 trillion, then you've got to ask yourself, how is this going to be funded? And with a debt trap, it means that the rates go up and up and up. And I mean, in Britain, we had this problem in the 1970s when we had a stagnating economy. We had huge government debt. It wasn't half as bad as it is today, yet we had gilt, which are our government bonds, gilt issues with coupons of 15%, 15.25%, and 15.5%. Now, just imagine what that does to US finances. You know, I mean, it's just going to blow them out of the water. And I wouldn't rule that out. I really wouldn't. The problem that the Fed has is, of course, because everybody's a Keynesian now or neo-Keynesian, they think that they can use interest rates to try and manage an economic outcome. But they won't have the option of reducing interest rates in order to do that. So what then happens to all this credit? Well, the problem is you've got all these zombie corporations who can't pay back their debts, including the commercial real estate industry. They can't pay back their debts to the banks, so they default on their loans. And the banks then find that the defaults rapidly start wiping out their capital, and they're then in negative equity. So you know, this is almost certainly the outcome of the current situation.
But if you take a look at, or if we look at the Treasury Secretary, Scott Bessent, he's been quite, how do you put this, quite talkative. He was not many days ago on Tucker Carlson show, and he seems quite focused about the 10-year yield. And 5% was apparently for him a kind of a threshold. Now the 10-year is about a bit over 4, I guess. That's one aspect. He's following closely the 10-year yield. And then again, he also talks, I've at least seen it a couple of times, he talks about gold.
Yeah.
Yeah.
Well, there are two things there. There are two things, Gregor, there. I mean, firstly, he is right that the 10-year Treasury note is probably the most important government bond in the world. It is, if you like, the one which everything else is sort of referred to. Now, having said that, the idea that he can cap this at 5%, he can't. I mean, if he was running a budget, a balanced budget, he would have a chance of doing it, but he's not. And what I'm saying is that with the economy going into recession and then into a slump, the situation is going to get worse. It's as simple as that, because the US government is in a debt trap and it cannot escape it. it does not have the, I mean, the modern phrase is the Overton window. It does not have, if you like, the political ability to address the real problems, which basically are too much spending by the US government. Now, we know also that, in a sense, Trump has tried to sort of hit the waist, with Doge, under Elon Musk. But, that's just fiddling on the edges. It really is. I mean, the real problem is that they've just got huge, huge expenditure in terms of welfare, in terms of defense. Those have got to be cut right back. And everything cut to the bone. And government's just got to step back from everything. That's not going to happen. Trump is an interventionist. He's not a free marketeer at all. Yeah. His idea is to go in and intervene, tell people what to do. And this is what I want. You do it. And this involves government spending. So that's not going to happen. Now, the mention of gold, of course, Besant was a trader. Famously with Soros in London many years ago. And it's one thing being a trader. It's another thing being secretary at the Treasury. He will be told very, very, and I'm sure he has already been told by his officials, look, do not talk about gold. Do that and you undermine the dollar. Do not talk about gold. Do not talk about an audit in of Fort Knox. And notice how that's disappearing out of the headlines. Nobody's saying anything. Keep stum. So that's actually what that is all about. So we can ignore that. He is being, if you like, absorbed into the system. So all these sort of previous thoughts he might have had and skills he had as a trader and all the rest of it are being either irrelevant or nullified. So I do not rate this at all. And talking about the Mar-a-Lago Accord and trading in Bitcoin and this new sovereign wealth fund and all. I mean, it's all absolute lunacy, rubbish, uninformed. It's not going to happen. I tell you one thing. I mean, apart from anything else, it's so far from the reality of government, but also with everything else going on the trade side, and this policy of tariffs, and we can see that's going to fail. Then I think the government has got far bigger problems than this sort of airy-fairy ideas of, well, we're going to look at a new sovereign wealth fund and all the rest of it. I mean, the whole thing is complete nonsense. It's also an accounting nonsense. But anyway, go.
Yeah. There's been much talk about the gold flows. You have the LMBA COMEX, let me call it thing. And you have also written about this many times, gold leasing. Germany wants its gold back. I think Germany has, 1/3 of its gold with the New York Fed. Yeah. Will they get it back? What's going on behind all?
I think the first thing to say is unlikely. I think it's unlikely that Germany will get their gold back. I mean, we had last time, they only, and I think this was something that happened after negotiations. They were only allowed to get 300 tons of their gold back, and it was going to take 7 years. Why? You just put the stuff on a few planes and it's there immediately. I mean, this is nonsense, absolute nonsense. There is something completely wrong at the New York Fed, which stores, if you like, gold on behalf of other governments. It's clear to me that that gold has been part of the gold suppression scheme over the decades. And in order to provide liquidity into the market, for example, gold has been leased. And, the way it works is quite simple. The Central Bank of Norway, for example, will be told, it's quite expensive storing your gold. Do you want to make it work for you? We will, we can lease it out and you can get an income on it. And of course, the accountants, if you like, with their calculators work out, well, this is not a bad idea. At least we can get this gold working for us or whatever. And, it's a source of income for something which is otherwise a sterile asset. So you can see that, how this has worked. But the problem is that once the gold leaves or is rehypothecated, you can't get it back. And this is what happens. I mean, I think the gold is probably basically there, but the problem is it's been leased out. It remains in the vaults, leased out, so that a commercial entity, whether it's a bank or a shadow bank or whatever, has got a bit of paper from the vault saying, you own X tons of gold, and that is what a lease does. So you've got at least double ownership. And if that gold has been rehypothecated in the market, you've got triple or quadruple or quintuple ownership. And of course, the Bundesbank sitting there and thinking, hold on a minute. The good reason we want our gold back, we don't like Trump, we don't like what he's doing, and we think the whole thing is extremely dangerous. We would rather have our gold back under our control. Hardly surprising that it's being discussed. It's not official Bundesbank policy. Bundesbank have denied, they've said that, we're entirely confident, if you like, in the arrangements with the New York Fed. But they would say that anyway. This, I think, became a real issue recently because we suddenly find that everybody was queuing up at the Bank of England's vault in Threadneedle Street to, take gold out, to arbitrage it into the COMEX warehouses, where there were substantial premiums, like, you could get $50 an ounce by doing that. And so basically what's happened is that on the one hand, that those premiums just sucked all the liquidity out of London and Switzerland and also other centres. But the second thing is that central banks are finding that the gold, which was meant to remain in the Bank of England vaults under the book entry transfer system, has actually gone out of the vaults. And are they ever going to get it back? I don't know. So I think what we will find is that as these leases fall due, they will not be renewed. So this is going to put an extra squeeze on the market. It's going to take the liquidity out of the market, which the market has been relying on over the decades. And that, I think, is a major change.
And then the gold probably has headed east. You've written about this as well. That's likely to... And then
Yeah.
I just want to make a short comment on that one, because there shouldn't be any doubt that the East, call it China, the BRICS countries, they have a completely different cultural understanding of what gold is. That's my thought, my opinion. Whereas we in the West, we've been suffering from this anti-gold propaganda since the beginning of the 70s, maybe even earlier. And
I think,
so
yeah. I think it's two things, Gregor. I mean, one is, yes, they are closer to gold, if you like, than we are. Let's put it that way. They do understand that gold is money, and hopefully they understand the rest is credit. But I think the other thing is that they are increasingly frightened about what's going on in the fiat currency world. And this is why for the last 4 years, central banks have been increasing their holdings of gold in aggregate by something like 1,000 tons or more every year. And of course, we don't necessarily see the gold which is being bought but not declared. I mean, either by sovereign wealth funds or maybe bought by, say, the People's Bank of China for its own reserves, but not actually declaring them. So, we can't actually measure this demand. And it has effectively cleaned the West out of its supplies, apart from this liquidity, which is now being compromised by the problems in New York. Now, there is another aspect of the New York problems, and that is there is something on COMEX called stand for delivery. Now, I've been monitoring these stands for delivery, and in the last year, in 2024, they totaled around about 1,000 tons. This is not inconsequential. This year, is accelerated under President Trump, if you like, so that if it continues at this rate, we're likely to see something like 1,800 tons stood for delivery. Now, it doesn't necessarily mean that this gold leaves the COMEX warehouses. It's quite a complex process, and not only that, but banks who don't really possess much gold, but have lots and lots of paper obligations, don't really want to part with their gold. So what they will do is they will hang on to the gold and they will sort of say, well, don't worry, we're looking after it for you, or whatever. So it can be quite difficult to get this gold out. As to who the buyers are, we really don't know. But it's interesting that at the last contract expiry, there was a huge amount of gold. I can't remember the exact figures, but I mean, we're looking at something like 30,000. Yes, I think it was about 108 tons. I remember that figure now. 108 tons was stood for delivery on one day, or actually over 2 days. The previous, well, not the previous one, but the one before that, we had an enormous quantity again, not as high as that, because what we saw on the expiry of the April contract, which expires at the beginning of the month, that was a record. So we're seeing there's some very, very big players doing this. I mean, you know, when you talk about 100 tons of gold, you're looking at the thick end of $10 billion, you know, as a payment. This is not trivial. This is really quite something. So, and if you look at what's happened in the past, I mean, particularly when we had the spike up at the time of COVID, just after COVID, if you remember, there was a similar crisis then. Warehouse stocks rose very substantially. And then between then and last October, November, they declined and declined and declined. In other words, they were gradually being withdrawn from, you know, the stands for delivery were gradually being acted upon and withdrawn from COMEX. We've now shot up to record highs, and that undoubtedly will be withdrawn from COMEX over time, meaning that the liquidity which the banks allegedly have just moved from London and Switzerland into New York, but still have it, they don't, is going to just disappear from the market completely. And I wouldn't be surprised if some of this is some smaller central banks trying to get in the act because they go along to the refiners and the refiners say, you know, join the queue, or they go along to bullion banks and the bullion banks say, well, you know, we can't, we might be able to let you have some, you'll have to leave it with us and it's going to take us 6 months to do it, whatever. Well, the answer is just go along to COMEX, buy some futures, take delivery, boom. And I think there's quite a lot of that sort of thing going on. And as well as that, of course, you've got sovereign wealth funds and all the rest of it, which are increasingly doing it. I mean, perhaps some in Eastern Europe, I mean, we've got the Polish central bank has been buying, for example. Some of the other Eastern European countries have been buying. But then you've got a plethora of countries developing an interest in gold. I mean, even in Africa, where there's quite a lot of mining activity as well. And they're looking at an overall policy, if you like, towards mining and towards holding gold as part of their reserves rather than dollars or euros or whatever. So, yeah, the squeeze on the market is very, very real, and I think it's going to continue. And I think it, particularly with central banks withdrawing from the leasing side, I think that is actually going to increase the chances of a systemic problem within the gold paper market system.
You mentioned sovereign wealth funds. And I happen to be from Norway. We're a small country, but we have the world's largest sovereign wealth fund by far. I looked at the numbers, and it's something like 30% larger than the next one, which is something China. I don't remember the name. Their allocation is 70% equities and 30% bonds. They do have some real estate, they do have some infrastructure investments. If Let me put it this way. If you were to be the CEO, the CIO of the Norwegian oil fund, what would you do?
Well, I would start selling down the credit in it, credit including equities, incidentally. Um, and I would do this sooner rather than later. I mean, because presumably, if you've got so much in the way of equities, it's predominantly US equities. And those US equities, I mean, you're in company with other foreign investors whose interests total around about $14 trillion worth. Now, you're not going to get foreign investors with $14 trillion of US investors with a bear market just sitting there watching prices go down. No, they're not. I mean, there's going to be selling. There's going to be big selling, and not only selling equities, but also selling dollars. So I think if I was CEO of your sovereign wealth fund, I would get on with it. I wouldn't hang around. I'd get out, and I would get some, put instead of buying currencies, other currencies. I mean, you could buy your own Norwegian kroner, I suppose. But what I would do is I would get hold of some physical gold. I'd even go to Comex and stand for delivery and get my lawyers onto it so that they don't prevaricate.
But then again, I think this, and I think I know this. This fund they have a strategic benchmark that says 30% equities, 30%, 70% equities, 30% bonds, with minimum and maximum limits. So
Yeah.
my thinking,
change it.
yeah.
Get out. Just get out. I mean, honestly, this is the most dangerous thing. I mean, as you say, a small nation with all this money which has come out of oil, which is fantastic. I mean, it's you're going to lose most of it. It's just going to go down the drain. It really is. I mean, governments are in debt traps. What are your bonds going to be worth as interest rates soar? Dollar interest rates for a start, and the dollar goes down and all the rest of it. And I'm assuming that the Norwegian kroner doesn't go with it, which is a big assumption, I must admit. I think it'd be terrible. I'd just liquidate the whole damn thing. I mean, obviously, you can't just run into the market and say, right, I want to sell X billion dollars worth of this and X billion dollars worth of that, because you just kill the market. But I would do what I could to get out. I really would, and I would accept lower prices to do it. Not disrupt the markets, hopefully, but I mean, the chance of getting it out, the time to sell is actually when prices are rising. When you're that big, now that they're going down, actually, you're probably trapped. You could probably get out of some bonds, I should think, but it's not.
As a matter of fact, they have 10% of the whole fund is invested in US treasuries.
10%.
Yes.
Yeah. Well, I would liquidate that for a start.
The only problem is that you have to talk to the politicians, right? They're the ones that's deciding.
Exactly. And the politicians aren't investment managers. I can't say that the investment managers would necessarily get it right either. But no, I mean, this is bull market stuff. Everything's going up and it's lovely and da-da-da-da-da. But, when things turn sour, they're not equipped to handle it, are they? I mean, they're really not. I mean,
I tend to agree.
Off camera, you told me the fund has no gold whatsoever.
That's true.
So, no gold. They don't know what they're doing. They really don't. At a time of heightened credit risk, and they have got no gold. And furthermore, I mean, central banks talk to each other. And you will find, okay, I'm sure that I don't know how much gold the Norwegian central bank has, probably very little.
Zero
again. Oh my goodness me. Go out and talk to a few people. Why are you buying gold? What's your thinking? Go and talk to a few people. That's what I would. I would really urge whoever is in charge of your sovereign wealth fund to go and do that. Go and talk to people. Go and talk to the Chinese. Why are you buying gold? Talk to the Russians. Why are you buying gold? Make an assessment on that if you don't actually understand the difference between money and credit, which they do. And then you get the message. But having said that, with equity markets now in a state of almost collapse. It's getting a bit late to start doing this. Mind you, it's never too late to get out of credit when it's going down.
No, with the size of the fund, they would have to buy enormous amounts of gold. I mean, we're talking thousands of tons.
Well, delay is no excuse for not doing it.
No, I agree. I agree. I even heard I just have to say this or tell this story. Even heard the CEO. He had said at some, or he has said in the papers, I guess, that well, the performance of the fund is going to be bad for the next 10 years, and there's nothing we can do about it. Inflation is going to be high. Performance is bad. We can't do anything about it. And I'm there thinking, well, what about gold? Buy gold.
Yeah.
What kind of attitude is this?
Yeah, the other thing they could do is they could buy, say, gold mining stocks. I think that, I mean, the China-Russia Shanghai Cooperation Organization BRICS story is really going to take off, I think, over the next year or two. So that's what that does is it gives you a clue about where you should invest and commodities. So you can invest in commodities, you can invest in copper mines, you can invest in obviously gold mines as well. You can invest in various other commodity production facilities. You can get involved with financing these things as well. I mean, you can actually shift quite a lot in that direction, even though, buying physical gold, I mean, it's really quite limited as to what you can do because of the limited supply, or the limited availability rather than supply. So, yeah, I mean, there are ways out of this. But from what you say, I mean, they're probably taking the view, well, we're our revenue stream is oil. Okay, that's really the origin of the sovereign wealth fund. So we've got quite enough, if you like, on the commodity side.
Yeah.
But that's where you should be, really. I mean, if you're going to diversify out of oil, then diversify into other commodities, I would say.
Yep.
Yeah.
Agree. Okay, I want to shift gears, kind of, and actually completely. And we had a little chat before this, and this is where I'm now getting at, Alasdair. You sent out a note on your Substack, I think about 2 weeks ago, and the title was "Keynes was a Socialist," and you linked to a video which was to be found on the Mises Institute's website, where a researcher, Edward Fuller, went through the story of John Maynard Keynes. I guess it's a way to put it. He was a socialist long before he wrote his book, The General Theory, in 1936.
Yeah.
And Fuller goes all the way back to 1906. And as we know, Keynes was the one that came up with the term macroeconomics, and he had his model, the ISM model. I'm saying that again. Can you unpack this? I feel that this is important to know who was actually Keynes, that wrote theory that we are all, call it, living under.
Yeah, this is very interesting in one sense, because in the past I've said that Keynes was a socialist, and I've had people say, no, you're completely wrong, etc., etc. He was never part of the Fabian Society, for example, and so on. But that article, that video did show that, he was actually involved with the Fabian Society in Cambridge. Furthermore, he applauded the Russian Revolution. Now, I think to a large extent, that's probably the idealism that we see today in students. They're very idealistic when it comes to socialism and communism and all the rest of it. Most people grow out of it. And I think in the case of Keynes, he did sort of grow out of it, but not completely. I think his roots very much were that the government can make a difference. The government, with sensible policies, can improve on free markets. And that basically was his stance. And that was why, in the general theory, he had to find a way of discrediting classical economics. Classical economics, basically, if you like, in accordance with Say's law, which wasn't a law so much, it was a sort of, generalization, that you need to produce things first before you sell them. In other words, production is tied to consumption. Now, it's not tied absolutely, obviously, because you can get variations between one and the other. So, but nonetheless, in general terms, unless you produce something, it's not going to get consumed. So this was the basis, if you like, of Jean-Baptiste Say's writings, going way back, turn of the 19th century. That was dismissed by Keynes in a really rather frivolous way. And as he stated, it's of course, and if that's no longer true, then there's a whole new, if you like, form of economics to be discovered or written. I can't remember the exact phrases he used. And that really was, as you say, the invention of macroeconomics. The problem we have today is that people actually don't understand this. So-called free marketeers, or people who operate in markets, sort of, I mean, their world runs on macroeconomics, and they now assume that the government can intervene and improve things. I mean, and this flies in the face of experience. Every time governments get involved, basically they screw things up. Oh, anyone who's actually paying attention to the way things work can explain this and understand it. What governments have managed to do is they've managed to cover up the problem, particularly since the 1970s, by expanding, if you like, base money. The quantity of money of currency in circulation, and also bank reserves. And they've done this basically to hide the deficiencies created by their own policies. So when you get companies or banks getting into trouble, they rescue them. And how do they rescue them? They just replace, if you like, private sector credit with government sector credit. And inevitably, it doesn't change anything. It just makes things getting worse. And I think a very good example of this is how things have progressed since the Lehman crisis, 2008-9. I remember at the time, lots of people saying, well, we can't allow the increase in debts which led to this crisis to continue. What happened? The increase in debts accelerated. And we now have, some extraordinary figures for the sort of global debt. I mean, we see assessments of sort of 330 trillion and so on, but that doesn't even include the credit which is all bound up in derivatives, because a derivative is debt and credit. You have an obligation and you have an expectation, debt and credit. So you can add several trillion on that. You've got all the temporary liquidity in foreign exchange market, which, because the way foreign exchanges work, in other words, if I'm going to buy Norwegian kroner in the market, I first of all have to sell sterling for dollars, and then I buy kroner with my dollars, so that you've got this enormous liquidity float, which the Bank of International Settlements reckons with a further 90 trillion. I mean, we have got so much debt now, Gregard, that any sort of collapse in it or implosion in it just cannot be stopped. It's a runaway train, I'm afraid, to the end of the rails. And I can't really, the traditional way in which governments stop this crisis happening is yet more debt. Yeah. I think we can't do that anymore. Yeah. I think we've reached the end of that.
Yeah, and complex systems, as you're describing, they're how they have to. Yeah, they get too complex, and then at some point, either a black swan, something we haven't thought about, just topples it out, it all down, something.
Yeah, well, with black swans, you get more and more of them if government gets involved. But to get back to your point about Keynesianism and his socialist background, the other thing that this showed, this Mises thing showed, was the way in which this been covered up by Skidelsky, who's his biographer. I mean, really, the establishment is in denial over Keynes's socialist credentials.
Yeah.
And in essence, there is actually no distinction, let's say, between socialism as we know it and government intervention. Socialism is government intervention. It's the same thing.
Yeah. I'll make sure to put a link. I know you have sent the video out. I'll put a link of the video in the description of this video. I noticed that the video only has 4,000 views. I've watched it several times and my jaw dropped when I watched it. I think it's important.
I do agree.
Okay, so last point. Regarding gold again, there's been much talk about a gold revaluation. Many numbers has been flying around. How do you see this? Will there be a gold revaluation event, or will the gold price just call it float higher by itself? When and where does this stop?
Well,
that's a difficult question.
I think there is a misunderstanding amongst the macroeconomists who think that the way to deal with the gold problem is to just revalue it at a higher level, if you like, it's some sort of new Bretton Woods at $10,000 an ounce. Well, they don't understand what gold is. They don't understand that it is money, and they don't understand that everything else is credit. That is not how it works. It really isn't. And particularly in the climate that we have, whereby, the political class, the central bankers, under constraint by the politicians, whatever they may personally think or privately think, and the whole of the investment and economic establishment thinking in Keynesian or neo-Keynesian terms, there is absolutely no way you can fix the price of gold to any currency at the moment. Doesn't matter about the level or anything. And when they're talking about $10,000, actually what they're saying is, well, we've got to allow for further expansion, further debasement and all the rest of it. So why not get the whole thing done in one? I mean, that's not how it works. The only way it can work is you have to accept that you've got to run economic policies from the government's end, which basically involve backing out of the economy, controlling the amount of credit, and pricing interest rates to manage your gold reserves. Then you can do it. We're nowhere near that. And I just do not see how in the West we'll get anywhere there, without a serious crisis driving us into that last resort, if you like, from the political end. So, when you see gold going up, in fact, what's happening is the purchasing power of the currencies are going down. And that's a process that's going to continue until that crisis actually happens. And as we stand at the moment, I would say that there is absolutely no lower limit for the purchasing power of paper currencies at all. Because we can't see the circumstances whereby everything will be sort of changed to the point where credit can be stabilized in terms of gold. I just cannot see it at the moment. We have to have a complete financial disaster, wipeout, whatever. It could be somewhere along that line that people start taking a better view and start thinking, hold on a minute, we've got to actually ditch the whole of this welfare state type system and get back to where we were before the First World War. Now, I think the Russians will do it. They can do it, and they can do it tomorrow. And the only reason they don't do it tomorrow is because the Chinese don't want them to. And they are, after all, in a partnership with the Chinese. China, I think, could also do it. But they will do it, I think, as as a last resort, because what China doesn't want to do is to disrupt the world. Its approach is let everybody else make the mistakes. We don't actually need to do anything. But there will come a point, I believe, where they will have to protect their own currency. So they will then go on to a gold standard. And between Russia and China, we're looking really at the two hegemons who will be running the rest of the world. Now that America's backing out and Europe's sitting there saying, oh, what do we do? What do we do? We don't know. We don't understand. Japan and Korea are sort of going into the Asian camp ready to protect themselves as much as anything. That's how I see the world evolving.
Yeah. Great. Thank you, Alasdair. I think I've used your time, as I should. I thank you for the interview, and wish you still a pleasant day.
Well, thank you very much for having me on, Gregor.
Okay, bye-bye.
Bye.